Good afternoon, ladies and gentlemen. The Monetary Policy Committee met on the 20th and 21st of March 2023, faced with new and existing headwinds undermining the full recovery of the global economy. These include the recent bank failures in the United States and Switzerland amidst widespread monetary policy tightening, which introduced a new dimension to the risk confronting the global financial system, as well as the persisting high but receding global inflation. The continued hostilities between Russia and Ukraine and its implication to the smooth functioning of the global supply chain also remain a critical strain to the recovery of the global output growth. In the domestic economy, output recovery progressed at a relatively moderate pace, while headline inflation trended upwards, albeit less aggressively, driven mainly by a marginal increase in food inflation. The committee assessed key risks to the global economy associated with these developments and their impact on the Nigerian economy, as well as the outlook for the rest of the year. 12 members of the committee attended this meeting. Global economic development. The Monetary Policy Committee noted the new and existing headwinds to the broad stability of the global economy. Primary amongst these is the risk of a global financial contagion from the recent bank failure in the United States and Switzerland. In Europe, the war between Russia and Ukraine has continued unabated, causing critical strains to the commodities and energy markets as supply chain bottlenecks remain, while the lingering risk of the resurgence of several variants of coronavirus persists after China set aside its zero-COVID policy. Furthermore, the deteriorating relations between the US, China, Russia, and some major oil producers in the Middle East continue to contribute to increased volatility in the oil markets. In the emerging markets and developing economies, the unfolding tight external financing conditions and shock spillovers from the advanced economies could further dampen the recovery of output growth. In the light of these developments, the International Monetary Fund (IMF) in its January 2023 World Economic Outlook forecast global output growth for 2023 at 2.9% compared with 3.4% in 2022. Growth is, however, expected to improve to 3.1% in 2024. While global inflation shows signs of deceleration, monetary policy normalization is progressing unabated, especially amongst key advanced economy central banks targeted at moderating global demand pressure. Price development across several economies is thus expected to remain high throughout 2023, but begin to decelerate gradually in 2024. The key factors expected to keep inflation above the long-run target of several central banks include the persistent disruption to energy markets associated with continued war between Russia and Ukraine, high commodity prices, and general disruptions to the global supply chain associated with uncertainties around the COVID-19 pandemic in China and the ongoing tensions between the United States and China over Taiwan's sovereignty. Across several emerging markets and developing economies, inflationary pressure has remained high, due largely to rising energy prices, high prices of grains, and exchange rate pressures associated with capital flows to high-yield US dollar-denominated assets. In the global financial markets, renewed fears of a global financial contagion are forcing investors to move away from the equities market to safer assets such as gold, while others seek higher returns in treasury securities with improved yields. With the several advanced economy central banks progressing with monetary policy normalization, global financial conditions will likely remain tight, thus reinforcing the reassessment of financial portfolios to reflect the risk aversion of investors. domestic development. Data from the National Bureau of Statistics show that the real gross domestic product (GDP) grew by 3.1% in 2022. During the fourth quarter of 2022, it grew by 3.52% year-on-year, compared with 3.98% in the corresponding period of 2021 and 2.25% in the preceding quarter. The economy remained a positive growth trajectory for 9 consecutive quarters while exiting recession in 2020. The improved performance was driven largely by sustained growth in the services and agricultural sectors, rebound in economic activities associated with economic recovery, and continued intervention in growth-enhancing sectors by the bank. Staff projections showed that output growth recovery is expected to continue into 2023 and 2024. The committee, however, observed with concern the marginal increase in headline inflation year-on-year in February 2023 to 21.91% from 21.82% in January 2023, a 0.09% point increase. This increase was attributed largely to a minimal rise in food component to 24.35% in February 2023 from 24.32% in January 2023, while the core component moderated to 18.84% in February 2023 from 19.16% in January 2023. The shocks to the food component were driven by the high cost of transportation of food items, lingering security challenges in the major food producing areas, and legacy infrastructural problems which continued to hamper food supply logistics. Broad money supply entry grew by 13.14% annualized in February 2023, year-to-year, below the 2023 provisional annual benchmark of 17.18%. This was driven largely by the growth in net foreign assets, which was attributed to the increase in foreign assets holdings of the central bank and decrease in foreign claims on other depository corporations. Money market rates reflected the tight liquidity conditions in the banking system. Consequently, the monthly weighted average open buyback rate (OBB) and interbank core rates increased to 12.74% and 12.54% in February 2023 from 10.14% and 10.35% in January 2023 respectively. The committee noted the continued stability in the banking system reflected by the performance of the financial soundness indicators. The capital adequacy ratio stood at 13.7%, non-performing loans NPL ratio of 4.2%, and liquidity ratio of 43.1% as of February 2023. The MPC observed the sustained improvement in the equities market in the review period as the all-share index and the market capitalization both increased to 54,915.39 and 29.92 trillion naira on March 17, 2023 from 51,251.06 and 27.92 trillion naira on December 30, 2022 respectively, indicating renewed investor confidence in the Nigerian financial market. The committee, however, noted the marginal decline in the level of gross external reserves to $36.13 billion in February 2023 from $36.14 billion in January 2023, a decrease of 0.7%, reflecting the downtrend in crude oil prices as global uncertainties persist. The committee reviewed the performance of the bank's various interventions aimed at stimulating production and productivity across the real sector. Between January and February of 2023, the bank disbursed 12.65 billion naira to 3 agricultural projects under the Anchor Borrowers Program, bringing the cumulative disbursement under the program to 1.09 trillion to over 4.6 million smallholder farmers cultivating or rearing 21 agricultural commodities on an approved 6.02 million hectares of farmland across the country. The bank also released the sum of 23.7 billion under the 1 trillion naira real sector support facility to 8 new real sector projects in agriculture, manufacturing, and services. Cumulative disbursements under the real sector facility currently stands at 2.43 trillion disbursed to 462 projects across the country, comprising 257 manufacturing, 95 agriculture, 97 services, and 13 mining sector projects. Under the 100 for 100 policy on production and productivity, the bank also released 3 billion naira under the Nigerian Electricity Market Stabilization Facility for capital and operational expenditure of distribution companies (DISCOs) aimed at improving their liquidity status and aid their recovery of legacy debt. This brings the cumulative disbursement under the facility to 254.39 billion naira. Our outlook. The overall outlook for the full recovery of both the global and domestic economies remained clouded by new and legacy downside risks. Available data and forecasts for key macroeconomic variables for the Nigerian economy suggest that the domestic economy will continue to recover for the rest of 2023 at a moderate pace in light of evolving and persisting shocks to the economy. The continued upward pressure on inflation, rising cost of debt and debt servicing, as well as deteriorating fiscal balances remain headwinds which may undermine the smooth path to a faster recovery. Accordingly, Nigerian economy is forecast to grow in 2023 by 3.03% CBN estimate, 3.37% federal government estimate, and 3.2% the IMF estimate. The committee's consideration. At this meeting, the Monetary Policy Committee focused its attention not only on the inflationary trends in most major economies in the world, but also on the reported impact of policy rate hikes aimed at reining in inflation on financial system stability in the global financial system. MPC hence took time out to discuss the recent bank failures in the US and Switzerland and an event that occurred following the persistent interest rate hikes in the USA and how this has adversely impacted the broad portfolio of banks in the United States. It noted that whereas NPR has increased by 500 basis points in Nigeria from 12.5% in 2022 to 17.5% in January 2023, the financial stability indicators in Nigeria shows that the Nigerian banking system remains resilient due largely to the stringent prudential guidelines put in place by the CBN, which has resulted in a strong buildup of not only the cash reserve ratio deposit in Nigeria, but also liquidity ratio and capital adequacy ratios. In the light of these strong financial stability indicators, MPC was comforted that its various decisions in increasing monetary policy rate has had positive impact on inflation, given that inflation rate had started to decelerate in Nigeria. The committee's major considerations at this meeting, therefore, focus on arriving at key policy mechanisms to shield the economy from emerging shocks from the global economy, as well as sustain its focus on domestic price stability. Headline inflation in the view of members remain high, with increased expectations of price development due to the perennial scarcity of PMS and ongoing discourse around the removal of fuel subsidy. With the prices of other energy products also rising, members stressed the importance of addressing price development. Committee also considered the continued impact of exchange rate pressure on domestic price levels and called for policies to attract both portfolio and foreign direct investments to Nigeria. It maintained optimism that the continued progress made with the RT200 FX program the Naira for dollar and other policies targeted at attracting diaspora remittances would continue to help improve accretion to the external reserves and improve liquidity in the foreign exchange market. While output growth remains on a positive trajectory, members call for increased monetary and fiscal coordination to support the recovery in the light of risks confronting the domestic economy. To this end, committee enjoined fiscal authority to explore other avenues to improve non-oil revenue to reduce the fiscal deficit and public debt. Following new risk of financial contagion emerging from the scenario of failed banks in some advanced economies, members examined critically the possibility of shocks to the Nigerian banking system from these banks and concluded that the Nigerian banking system remains reasonably insulated from such likely contagion. The bank has been able to achieve this through stringent micro and macro prudential guidelines that has ensured that individual banks and the banking industry in Nigeria have adequate buffers to ward off global contagion. In addition to this, MPC examined the possible impact of further policy rate hikes on the stability of the banking system and was convinced that further rate hikes would not adversely impact the stability of the banking system. Committee, however, called on the bank's management to strengthen its regulatory oversight on the banking system to ensure that the banking industry remains stable and resilient. The decision, MPC noted that while the continued rise in headline inflation remained a significant problem confronting the economy, other macroeconomic variables were moving in the right direction despite observed headwinds. The committee's debate at this meeting therefore was whether to continue its rate hike to further dampen the rising inflation trajectory, or hold to observe emerging development and allow for impact of the last 5 rate hikes to permeate the economy. Loosening, in the view of the members, would gravely undermine the gains so far achieved. MPC observed the continued upward risks to price development around expectations on the removal of the PMS subsidy, rising prices of other energy sources, continued exchange rate pressure, and uncertain climatic conditions. This, in the view of members, provides a compelling argument for an upward adjustment of policy rate, albeit less aggressively. Committee, however, noted that the Naira redesign and cash withdrawal limit policies have resulted in a sizable reduction in currency outside the banks, indicating expected improvement in the potency of monetary policy tools. Members, however, remained aware of the ongoing challenges associated with the limits imposed on cash withdrawals in the face of frequent downtime in bank electronic transaction channels. Committee thus called on the other depository corporations, online payment platforms, and other stakeholders to ensure that the prevailing incidence of network failures is overcome in the immediate and short term. This would ensure that the Naira redesign and cash withdrawal policies lead to an improved inroad of the CBN cashless policy program and efficiency of the transmission mechanism of monetary policy. Members thus resolved by a majority vote to raise the monetary policy rate MPR by 50 basis points. In summary, 10 members voted to raise MPR by 50 basis points, 1 member voted to raise MPR by 25 basis points, and 1 member voted to hold the MPR. All members voted to keep all other parameters constant. The MPC therefore voted as follows. 1. Raise the MPR to 18%. 2. Retain the asymmetric corridor at plus 100 and minus 500 basis points around the MPR. 3. Retain the CRR at 32.5%. And 4. Retain liquidity ratio at 30%. Thank you for your attention.
Thank you, Governor. That was Monetary Policy Communique number 147, read by the Governor. We have some questions from the media.
Good afternoon, Mr. Governor. We don't want to from Business Day. I think my concern is on the uptick in inflation, which we're seeing, and which, of course, you alluded to, during your presentation. So, is there any policy options? Are there any measures that the CBN is possibly exploring or, looking at, to tame inflationary pressures that we're seeing? Seeing that inflation has, risen now for 2 consecutive months,
That's what you want to go, right?
Yes, from Business Day. Thank you.
Thank you. My name is Sunday Michael Ogun. I write for Daily Trust newspaper. Mr. Governor, following your acknowledgement of what had happened in the United States with the SBV and the impact in Switzerland, I was wondering, when you said the committee had evaluated and confident it would not have impact on our system, but I would like you to please expatiate on the level of the exposure of Nigerian financial system, especially startup, to the SBV collapse. Thank you.
Level of Nigeria's exposure to SVB, 0.
Good afternoon, Mr. Governor. I'm Nancy Naji. Good afternoon, members of the MPC. My question is, with the aftermath of the Supreme Court's judgment on the legal tender status of 200 naira, 500 naira, 1,000 naira, and also in light with the bank statements last week, I really like to know what is the state of the country's money supply, vis-a-vis that a lot of Nigerians are still cash squeezed, and we have many failures concerning banking transactions as well as online transactions. Thank you, Governor.
Good afternoon, Governor and MPC members. My name is Biodun Dare from Radio Nigeria. Findings have shown that a lot of people are actually in support of the ideals of the cashless policy, but the problem of seamless network for this connectivity has been a problem, appearing to frustrate this policy. What is the CBN doing to remove this impediment to seamless network for transactions?
Thank you. We have 2 questions from outside. Bukola Ido of Leadership newspaper sent this. Governor, sir, the bank in the process of carrying out its campaign on adopting the newly redesigned banknotes also encouraged Nigerians to embrace the eNira. What is the adoption rate of the eNira thus far? Another question from Babajide Komolafe of Vanguard newspaper. At a recent conference of central bank governors and financial regulators held in Joburg, South Africa, you were reported to have advised banks to ensure tighter regulations to guard against a run on the banks. Can you take us through the systemic health status of Nigerian banks? Thank you, Governor.
Very much for those questions. I think the first question from Oyin bordered on the fact that she said that the latest figures from National Bureau of Statistics indicate an upward trend in inflation, with inflation standing at 21.9 as of February 2023. And what other strategies are there left for the monetary policy authorities to reverse this trend? Well, first, I think we must appreciate the fact that between April 2022 and August 2022, we're seeing a very steep rise, a very steep slope in the rate of increase in inflation rate in Nigeria. The rate of acceleration was quite steep. But by around May, from the May meeting when the global pressures on inflation began to show real signs globally, we also started to raise MPR, albeit in an attempt to tame the aggressive rise in inflation. And what we saw is that because of the actions that we have taken, the rate of increase in prices, which is inflation, had begun to decelerate. For instance, between April and August, the rate of increase in inflation was about 5%. But between August and even now, the rate of increase in inflation is only about 1.4%, right? Because of the tightening measures that have been adopted by the CBN over this period, which, yes, what one would expect is that because we're tightening, inflation should immediately begin to drop. It doesn't happen that way. What you will find, particularly in our environment, is that as you are tightening and you see, or before you start tightening, and you see inflation moving very aggressively, and you begin a policy of tightening, what you want to do first of all is to stem that rate of increase before you begin to see a reduction. Once you achieve the kind of moderation in the rate of increase of inflation, the next thing you're going to begin to see is that it should begin to come down as you continue your tightening policy. That is what we're doing. Whereas you will see that the transmission mechanism in some economies is that it's almost direct. As you are tightening, you are seeing inflation trending downwards immediately. But it differs, the rate of response differs from one economy to another economy. The Monetary Policy Committee was comforted at this meeting that the fact that the tightening measures had started to reduce the rate of increase in prices, which is inflation. We believe that as we continue this process, that inflation will eventually begin to trend downwards. Are we optimistic that, for instance, this March meeting, are we optimistic that by May, inflation would have started to trend downwards? No, we're not that optimistic for a range of factors. Whether we like it or not, between now and May, or the end of this administration, we expect that subsidy will disappear. Subsidy removal has its own implication on prices, which is inflation. Because monetary policy is not optimistic that prices will continue to come down because of these measures, monetary policy feels that we need to continue to tighten. And that's what we did at this meeting. What would also continue to be the strategy? The important thing is for us to continue to look at what is the margin between policy rate and inflation. The margin between policy rate and inflation has remained wide, which is negative real rate. And in economics, when you find negative real rate, it is a disincentive to even investment. And so everything has to continue to be put in place by monetary policy authorities to see that we reduce that margin or that gap in the negative real rate by ensuring that inflation comes down. And whatever needs to be done to rein in inflation, we have to continue to do so. So that will continue to be the strategy, but we'll do it more moderately going forward because we are conscious of the fact that when you over-tighten, just like we have seen in the US and in Switzerland, that it could begin to have contagion effect and negative impact on banking system and financial soundness indicators and financial system stability in an economy. So those are the kind of balance that we're looking at monetary policy to see that, well, whereas we want to continue to tighten so as to rein in inflation, we must do it in such a moderate manner that we try to achieve the moderation in inflation rate, but at the same time without creating financial system instability in our economy. Unfortunately, that is where we are because of the uncharted territory that we have found ourselves arising from various geopolitical tensions that we have seen all over the world. So what am I saying in summary? The strategy would be, how do we reduce the gap in the negative real rate? To reduce that gap in negative real rate, we will continue to tighten, albeit moderately, to ensure that we achieve the level of inflation, which may rather now be over a somewhat prolonged period of time, so that if you do it more aggressively, it could have some negative impact on banking system stability and financial system indicators, financial soundness indicators. So that will be the strategy. It's a difficult balance, but that is the job we have to do, and we have to make sure we do it correctly. The second question talked about we should please try and look at the level of exposure of Nigeria's financial system, especially startups in the SVB. Like I said earlier, immediately this happened last week, we tasked our banking supervision department to ask for the bond portfolios, which is the main area of investment of banks in order to earn some relatively high yield. And the reports that came back to us is that there is no direct investment by Nigerian banks in SVB that could result in a loss of investment there. That's on one part. But on the second part, we began to say, how are we sure that the Nigerian banking system is reasonably insulated to ensure that what happened in the United States does not happen in Nigeria? So we reviewed the various prudential guidelines that were put in place. Nigeria, like I said in my discussion when I went to Joburg, Nigeria, being one of the countries, is one of the countries, or few countries in the world where we have cash reserve deposit requirement. What is cash deposit requirement? It has been there even before I started banking, that when you deposit your money in a bank, a certain percentage of that deposit is held or sterilized at the Central Bank of Nigeria to ensure that when there are kind of liquidity crises, that money is available to that bank for them to use to solve that liquidity problem so that depositors don't lose their money. 2, we also have liquidity ratio, which is an indices of specified liquid assets against total deposits of banks, either held in cash in bank vaults or bank balances or money at call, treasury bills, OMO bills, and different other liquid instruments. And in Nigeria, our ratio is minimum of 30%. Banks keep above that. Today, liquidity ratio is almost about 43%. Cash reserve, we all know, just like we read, is about 32.5%. The loan deposit ratio, which means that banks are not over trading, is just about 52.47%. But we are happy that in spite of maintaining these prudentials, that the banks still remain profitable. The ROIs, the return on equities or return on profitability ratios have remained, I would say, relatively strong, even though when banks convert those profitability from naira to dollar, they seem weaker, but at the same time, the Nigerian banks have continued to make profit and they have continued to pay good dividend to their shareholders. So, in sum, we will say that the Central Bank of Nigeria has prudential regulations or guidelines that have insulated the Nigerian banking industry from this kind of risk that we see, or contagion that we see or we saw last week in the United States. Nigeria, again, is one of those countries in the world where even after a bank has declared profit and paid taxes, a certain percentage of its profit must be set aside in order to build retained earnings and capital. If you're a small bank, it's going to be 25%, 1/4 of whatever profit you made is set aside and built into what we call the statutory reserve fund in order to improve the capital of that bank. If you're a big bank, then it is reduced to 15% of your profit after tax that is held back to build your retained earnings and your statutory reserve fund towards ensuring that your capital adequacy ratio remains strong. So I believe we've done well. Most banks are unhappy when this issue of cash reserve ratio comes up, or they tell their customers the central bank has done and done that. But I think at this time, people should now come to realization that there is good reason for putting this in place. And today is a day of reckoning where we are looking at that and say, thank God we have these prudential guidelines that have helped to insulate Nigerian banks from a kind of contagion that we've seen in the United States and Switzerland since last week. Nancy says that in the aftermath of the Supreme Court judgment, what is the current status of money supply and all that? Money supply has various components, but I think what is important that I think you'll be looking at is the currency in circulation. Before the Naira design, we said there was about 3.23 trillion Naira in circulation, out of which only 500 billion Naira was being held in the banking system and 2.72 trillion was being held outside the banking system. And with the Naira redesign, current, and it was published even in the newspaper yesterday, currency in circulation is roughly close to 1 trillion naira. And CBN continues to pump the newly designed currency into the market. But the truth is, at some point, we will need to reassess again to know whether the currency in circulation has attained an optimal level, so as to be able to put in place measures that will ensure that we don't go back to what we had before, where people were keeping a lot of money outside the banking system for their own personal benefits and the rest of them. 4, there are also the findings by the media indicate that a good number of Nigerian banks are actually, Nigerians are in support of the cashless policy. But of course, if they saw that why they're going into the cashless, which is like adopting alternative channels other than cash, that some of the online channels did fail. I must apologize, yes, online channels failed, but no doubt it was a result of the deluge of volumes of online transactions that hit the banking industry. And I think it's currently being resolved, and we are following up on daily basis. Our payment system management department follows up on a consistent and daily basis with the banks to ensure that where there are downtimes, they are resolved as quickly as possible, so as to make sure transactions go smoothly. I know that some of our Nigerians will say that some of them had persisted, but those are very, very isolated cases where I will say that they had persisted. But everything is being done. But of course, I think at this stage, I must really thank some of our fintechs who have some idle capacity, have been able to use those idle capacity to boost their online payments, and they have made a lot of money from that, because online payment in the fintech sector has actually increased quite astronomically. And we are happy that rather than relying on just only the banks, we have many other channels through which online banking, online payment services can be done, so that Nigerians don't suffer because we are insisting that we have to go cashless. Bukola Seto says that in the process of carrying out the campaign for the adoption of eNira, what is the adoption rate of the eNira? I can only say that the adoption rate continues to increase and improve, and everything is being done to continue to make sure that this continues to go up. For instance, the eNira, the report that we have shows that the eNira has emerged as the electronic payment channel of choice for financial inclusion and targeted social intervention programs. Within the last 18 months, when the eNira was launched, we've recorded over 13 million wallets. And these wallets are categorized based on their level of usage, with 12.6 million at tier 0, 11,354 at tier 1, 367,000 at tier 2, and 9,649 at tier 3. But one notable example of areas where the eNira has been adopted, and I think we must thank them, is the Ministry of Humanitarian Affairs and Disaster Management and Social Development, which has expressed keen interest in our eNira product. For instance, as on March the 20th, which was just 2 days ago, approximately 4 million wallets were created, especially for social intervention payments, representing about 30% of the total wallets created so far. These wallets were created in response to a request from the ministry as part of plans for the next tranche of the conditional cash transfer program, which is scheduled during the second quarter of 2023. There are other very good and encouraging data that we've seen. Like I said, number of e-wallets created is about 13 million naira, 13 million of them. The value of eNira transactions has reached almost 22 billion naira, which is a 68% increase since the beginning of this year. Over 10 billion naira of it had been minted, and about 3.429 billion naira of it is currently in circulation. So I would say we've seen good progress in the adoption of eNira, and we're happy that as we try to move more and more towards financial inclusion and get people away from being exploited from the financial system, that eNira remains one very, very portable option for you to adopt the cashless policy. That at a recent conference in South Africa, the CBN governors, right, and this asking that I was reported to have advised Nigerian banks to ensure tighter regulations, not just Nigerian banks, banks generally, to guard against a run on the banks. Can you explain, can you take us through the systemic health status of the Nigerian banking industry? I think I have some data here. Like I said, that we had put in place a couple of prudential guidelines to insulate the Nigerian bank, and that we say and make bold to say that the financial soundness indicators in Nigeria, in the Nigerian banking industry, shows that Nigerian banks remain very, very resilient, not just resilient, but very, very resilient compared to what we find in other climes. For instance, capital adequacy ratio, which is meant to be between 10 and 15%, today is about 13.7%. Non-performing loans ratios has dropped to 4.2%. Liquidity ratio is about 43%. Return on equity is at least 21%, which we think is reasonable. And like I said, NPLs at 4.2. Cash reserve today, aside from the special bills that we're keeping, we are today holding close to about 14 trillion naira in cash reserve deposit from banks. This is good liquidity that is meant to actually act as insulation just in case of problems. Also on the loan deposit ratios, the banks today are just at 52.7%, which means they are not over trading. They are diversifying their portfolio to ensure that they have ample liquidity or ample zero risk investments or securities where they make money, but at the same time, depositors' funds remain protected. What we saw at the aftermath of the SVB program in the United States is that the government came out to say, the United States government, President Biden himself came out to say that that all depositors of SVB or the other bank, that they will be paid all their monies, notwithstanding the fact that what is secured, what is guaranteed is $250,000. This is something that even in Nigeria we have been doing on our own, either as a result of certain guidelines put in place, prudential guidelines put in place by the CBN, or as a result of collaboration between the CBN and the banks. We have made sure that even when banks are taken over by the CBN, that whereas the shareholders may lose their investment, there are no depositor, as far as I know, since 2008, has lost its deposit in Nigerian banking industry today. Not one. It is because we insist that, yes, shareholders today, from our own standpoint in CBN, are seen to be less important than depositors. In fact, we've gotten to a realm where we're beginning to see that banks are owned by depositors, not by shareholders. Because if you look at the balance sheet of an average 5-year-old bank today, the size of depositors' funds is at least close to between 7 to 10 times of shareholders' funds. And that's why we come out very strongly when we find shareholders misbehaving in banks. We do not spare them because we will continue to repeat that the banking license is a privilege. It is not a right. The banking license is the property of the Central Bank of Nigeria that can be withdrawn at any time once we find that the shareholders are misbehaving. This is a policy that the Central Bank has held on to even before I became the governor of CBN. And I know that even now, or even after I would have left office, that whoever will be governor of Central Bank will insist that shareholders cannot continue to have the kind of right they think they have to run a bank anyhow, run them aground, and make depositors lose their deposit. We would rather dispense with the shareholders than make sure that depositors do not lose their deposits. So I thank you all for your attention.
Thank you, Governor. We have come to the end of the briefing. Thank you for being with us this afternoon.